Three big announcements after hours today. Amazon, Intel, Apple. First off, Amazon. Amazon is down 10% after hours. They reported a lot of interesting stuff today. So let's go right to the report. First off, operating cash flow decreased 41% to $39.3 billion. Guys, first off, in terms of revenue, they beat by $100 million. They got $116.4 billion in revenue versus the estimated $116.3 billion. Secondly, they missed on earnings, EPS. They had a big Rivian write-down of $7.6 billion. But this is what I want to focus on here. If you look at the write-down, so free cash, let's look right here. Operating decreased, operating income decreased. Net loss was $3.8 billion, or $7.56 per share, compared with net income of $8.1 billion last year. But the net loss included a loss of $7.6 billion. So $3.8 billion plus the 7.6 equals $3.8 billion in gain, which was still less than half of last year's $8.9 billion. So I asked the question, if the revenue is growing like it is, because they did have big revenue growth year over year, if you look right here, net sales increased to $116 billion in the first quarter compared to $108 billion. So they had an $8 billion increase in revenue, but profit, even adding back in the Rivian loss, was still down $4 or $5 billion. That is a concern. Now, Amazon, we will get into it, but you guys all know my opinion on Amazon. What we're going to do here is we're going to pull up our 8 pillars and see where Amazon needs to be for it to make sense for us. So let's pull up Amazon real quick. On the 8 pillars tab, guys, a lot of X's here. Expenses on the ratios, price to free cash flow and PE, very low return on invested capital. Now that could be because they're investing a lot of money on their free cash flow to grow. I'm fine with that. Diluting a little bit, shares outstanding, but they got a lot of debt compared to their free cash flow. But it is a high growing business, and I believe the return on invested capital will be greater once they stop investing back into their infrastructure so much. Now, I will say their 52-week high is $3,700, and they're currently at $2,600 per share after hours. Let's go to the stock analyzer tool. Now, revenue growth. Guys, I want to see what this thing is worth. So I'm using our stock analyzer tool. I'm going to be conservative on revenue growth numbers for the next 10 years. I'm going to do 6, 9, and 12%. You might sit there and say, that's so low. Guys, I have a hard time believing these guys are going to grow at these same levels as before. It's just a hard thing to do when you're almost one of the largest companies in the world in terms of revenue. Profit margin. I'm going to do 5, 6.5, and 8, assuming AWS keeps growing. Free cash flow margin. I'm going to do 3.5. I'm going to do 4. I'm going to do 5, and I'm going to do 6. PE. 13, 16, 19, 13, 16, 19. And guys, the bigger the company, the lower the PE with less growth potential. And I always do a 12.5% return to account for margin of safety. Guys, I still see Amazon as expensive. The low end of $500 or $700, the high end $1,500 to $2,000, somewhere in the middle about $1,000. For those of you who are new to the channel, just watching us, we're a value investing channel. I make conservative estimates on companies and determine where I want to be with the company. I just think Amazon's expensive. I am looking for it to fall. This is why it's falling so much. After hours, it's down about 10%. Our numbers include the open of the day. So overall, even from the start of the day when it went up a lot, it's still down 3% overall. So just be cautious with Amazon. In order to justify today's price, let's see what return you have to be willing to get for the next 10 years. I mean, you have to basically be willing to get a 3% return to be somewhere in the middle. That's just over long periods of time. Warren Buffett says stocks are a voting machine in the short run, a weighing machine in the long run. For those of you who don't think that would happen, listen, Amazon was 3,700 just months ago. Now it's 2,600. That's a fall of 30-some%. Just be cautious. Be ready to go. Next company, Intel. Anybody who watches this channel knows I think Intel is undervalued. Here's the press release from Intel. Now, on the GAAP basis, revenue came in at $18.4 billion versus last year of $19.7, down 7%. Gross margin, down also. R&D, up, which I like the fact they're spending on R&D because AMD's nipping at their heels. They have to figure out a way to make sure that they're staying in front of everybody technology-wise. Some of the things that are good, their operating margin. Their operating margin was up 4.9% from 18.8 to 23.7. Net income was actually up from 8.1 billion, from 3.4 billion to 8.1, and the earnings per share crushed on a GAAP basis, 1.98 versus 0.82 last year. So the first quarter, the company generated 5.9 billion in cash from operations and paid out dividends of 1.5 billion. Now, I think Intel's a value play. It's currently down 4 or 5% after market. Let's see where it is right now. It's down 4% after market. Let's go take a look at Intel in our stock analyzer, in our entire software. So overall for the day, it's down about 0.5% when you include after hours and during the day. 8 pillars tab. So guys, it's a 7 check mark business. The only one that's bad is the cash flow is down, which we expected. They announced, hey, we're doing a lot of growth. We're going to plan for a lot of growth, so we need to invest back in ourselves, one of which is right in our backyard, just an hour and a half south of here in Columbus, Ohio. They're building a $20 billion factory at some point here shortly. So I'm still a believer in Intel because of these main multiples. 5-year PE of 10, 5-year price to free cash flow of 13, and they're buying back shares. All right. I like that. Low debt. I believe that everybody's ignoring Intel's potential for the future, their big cash ability to generate cash to reinvest back in themselves. So what do we think Intel is actually worth today? Let's go to Stock Analyzer tool. Now, revenue. I'm going to do very little revenue growth. I'm going to sit there and say 2, 4, and 6%. Profit margin. I'm going to do 20, 22, and 24. Free cash flow margin. 17, 19, and 21. Actually, you know what? 17, 18, and 19. PE, 12, 14, 16. Low growth company. I want to do a low multiple. And again, 12.5% for my return because I can get 9 or 10% from any sort of ETF. So guys, it's at $45 right now. And my price is low end 35 to 40, high end 60 to 75. It's right there, right in the middle right now, right? Just below our middle number. So again, I'm accumulating shares of Intel. I'm not doing it. I'm not telling you to go do it. We're trying to teach a process on this channel. So what I'm trying to do is I sell puts on Intel at lower prices. So I get paid to wait. And if they hit those lower prices, I get the shares. If they don't, I'm fine with that. But I am a long-term believer in Intel. I think people are being overly dramatic about where Intel's future is. So as of right now on Amazon and Intel, on Amazon, I'm still holding, waiting for it to drop significantly in price. It becomes a value play for me. And on Intel, I am going to sit here and keep accumulating shares. All right, guys. So Apple just announced now, and they beat on everything in typical Apple fashion. This is their actual press release. March quarter revenue record of 97.3 billion, up 9% year over year. Guys, remember, the days of Apple growing 20, 30, 40%, as it gets bigger and bigger and bigger, it's going to be harder. Plus, with supply issues, I'm actually still impressed with this. And earnings per share of $1.52. They beat on that one as well. They've done a great job. They're still doing a great, they're still doing their buybacks. This is a big reason why Warren Buffett and Berkshire Hathaway loves them. It's a great company. But remember, on this channel, we're trying to separate company from stock price. So even though the company is wonderful, we're trying to look at the fundamentals and say, what are we willing to pay for that future stream of cash flow, right? That's what matters. If we pay $1 today, what can we expect to come to us in the next 5 or 10 years? So that's what we're here to do with our stock analyzer tool that we did earlier. So let's go. I was just looking at Robinhood because they're in a little bit of a tizzy right now. So let's pull up Apple. Go right here. So first off, we're going to go to our 8 pillars. So right now, Apple, we love it. You know why? They got all the metrics we love except for 2. Valuation, price to free cash flow, and the price to earnings over the last 5 years. So this is a company that, as long as they can give us enough back in our money, then we're okay with it. But the question is, at $167 a share, is the juice worth the squeeze? So let's go to our stock analyzer tool. Now, we're looking at 10 years. And for those of you who are new to this channel, I repeat over and over, like I said, when I was talking about Amazon and Intel, remember, we're a value investing channel. For those of you who say, well, Warren Buffett loves Apple. He didn't buy Apple at $167 a share. I don't know if he's buying more Apple. He loves Apple. He thinks it's great, but he bought them a lot lower. So just keep that in mind when you sit there and look at Apple. Don't let that mask you. So look at their 10-year revenue growth numbers, 9.7% a year. So they're a big company. So I'm going to go, and I want to be conservative. 4, 6, and 8. Profit margin. I'm going to do 21, 22.5, and 24. Free cash flow margin. I'm going to do 23.5, 25, and 26.5. PE. This is where I'm going to get all the haters. Guys, don't hate on me. The bigger the company, the lower the PE. Remember, Apple was an amazing company in 2015. I think it was selling for like 10 times earnings. Okay? Just remember that. You pay a higher PE for more growth potential. You pay a lower PE for less growth potential. Just remember that over and over. And single digits is not huge, but it's not bad. So I will say, for those of you who like Apple because of its high return on invested capital, can you justify a higher PE? Absolutely. But we have 3 nice ranges here. Maybe I'll do something. Actually, you know what I'm going to do different? 13, 16, 19. Make it a little bit better. Analyze. Guys, and I kept saying I'm looking at Apple at around 120. The low end of 60 to 70. High end of 115 to 125. And in the middle, 85 to 95. So it's still expensive. You might sit there and say, oh my God, this guy is crazy. Go look at our other videos. Look at all the times everybody thought I was crazy and stocks fell 60, 70, 80%. It happens. Even these darling stocks. I mean, it feels like Apple can't miss. I get that. But let's just go look at Apple and see its 52-week high and low. Its high is 182. Its low is 122. That's a 1/3. That's a 33% difference. 50% higher from the low, 33% higher from the lower from the high. So just keep that in mind. If this makes sense to you, if you like looking at buying stock as buying a share of a business, please keep watching our videos. It's a great way to do it. I appreciate you guys spending your time with me. Thanks very much.